Question 1. Scenario-based. Davidson Insurance Company, based in Massachusetts, has entered into a quota share reinsurance treaty with Liberty Re. Under the terms of the agreement, Liberty Re will cover 40% of all policies underwritten by Davidson Insurance. One of the policies issued by Davidson Insurance has a $1 million limit, and a claim for $750,000 is filed under this policy. How much will Liberty Re be responsible for paying under the quota share treaty? A. $300,000. B. $400,000. C. $450,000. D. $500,000. Answer: B. $400,000. Explanation: in a quota share reinsurance treaty, the reinsurer agrees to cover a fixed percentage of all policies and claims underwritten by the cedant, the original insurer. In this case, Liberty Re has agreed to cover 40% of all policies issued by Davidson Insurance. Therefore, for a claim of $750,000, Liberty Re equals $750,000 x 0.3 equals $300,000. Davidson Insurance will cover the remaining 60% of the claim. This quota share arrangement allows insurers to transfer proportionate share of risk to the reinsurer, which helps in maintaining solvency and managing capital efficiently. Quota share treaties are regulated under the Massachusetts Insurance Code to ensure that both parties meet solvency and reporting requirements. Question 2. Underwriting and risk assessment in reinsurance. Which of the following is a primary consideration for reinsurers when determining retention levels in a non-proportional excess of loss treaty? A. The cedant's profitability history. B. The reinsurer's regulatory capital requirements. C. The likelihood and severity of large losses. D. The number of policies issued by the cedant. Answer: C. The likelihood and severity of large losses. Explanation: in a non-proportional excessive loss treaty, the reinsurer covers losses above a specified retention level, also known as an attachment point. The reinsurer's primary concern when setting retention levels is assessing the likelihood and severity of large losses that could exceed the retention threshold. Reinsurers analyze historical loss data, catastrophe models, and actuarial to determine appropriate retention levels. Retention levels must balance risk transfer with the cost of reinsurance coverage. This is a critical aspect of risk management, especially in jurisdictions like Massachusetts, where regulatory frameworks ensure that insurers maintain adequate reserves and capital to cover potential claims. Options A, B, and D are incorrect because they profitability history is more relevant for general underwriting. B. Regulatory capital requirements affect the reinsurer's overall capacity but are not specific to setting retention levels. D. The number of policies is not as relevant as the potential for large losses. Question 3. Massachusetts-specific reinsurance practices. Under Massachusetts law, what is the primary purpose of requiring reinsurers to maintain trust accounts or security deposits when conducting business with unauthorized insurers in the state? A. To reduce administrative expenses for the reinsurer. B. To ensure timely payment of premiums to the cedant. C. To protect the cedant from potential default by the reinsurer. D. To comply with federal financial reporting requirements. Answer: C. To protect the cedant from potential default by the reinsurer. Explanation: Massachusetts regulations require unauthorized reinsurers to establish trust accounts or post security deposits to protect the ceding insurer from potential default. This requirement is part of the state's financial solvency framework designed to ensure that Massachusetts insurers are not exposed to undue risk when dealing with non-admitted reinsurers. Court: the Massachusetts Insurance Code MGL, Chapter 175, Section 206. This safeguard ensures that funds are available to cover claims if the reinsurer fails to meet its obligations. Options A, B, and D are incorrect because A. Trust accounts are not intended to reduce administrative expenses. B. The purpose is to protect against default, not to manage premium payments. D. The requirement is driven by state, not federal, regulations. These trust accounts are part of the broader regulatory framework to protect policyholders and ensure financial stability in the Massachusetts insurance market. Question 4. Legal and regulatory framework in Massachusetts. Which of the following is a key requirement under Massachusetts law for a reinsurer to be considered authorized to operate in the state? A. The reinsurer must maintain a physical office in Massachusetts. B. The reinsurer must be a member of the National Association of Insurance Commissioners (NAIC). C. The reinsurer must demonstrate financial solvency and file an annual statement with the Division of Insurance. D. The reinsurer must offer both proportional and non-proportional reinsurance products. Answer C. The reinsurer must demonstrate financial solvency and file an annual statement with the Division of Insurance. Explanation: in Massachusetts, for a reinsurer to be considered authorized, they must meet financial solvency standards set by the Division of Insurance, DOI, and file annual financial statements. These requirements ensure that the reinsurer can meet its obligations to ceding insurers. Options A, B, and D are incorrect. A physical office in the state is not required. B. Membership in the NAIC is not a mandatory requirement for authorization. D. Reinsurers are not required to offer both types of reinsurance to be authorized. Massachusetts regulations prioritize solvency to protect policyholders and ensure the stability of the insurance market. Question 5. Claims management in reinsurance. In a reinsurance dispute between a cedent and a reinsurer, what is the primary purpose of including an arbitration clause in the reinsurance agreement? A. To ensure the dispute is resolved in a court of law. B. To allow the cedent to avoid paying claims during the arbitration process. C. To provide a faster, more confidential method of resolving disputes. D. To require both parties to agree to all claims settlements before arbitration begins. Answer C. To provide a faster, more confidential method of resolving disputes. Explanation: an arbitration clause in a reinsurance agreement ensures that disputes are resolved outside of court, providing a more efficient and confidential process. Arbitration is commonly used in reinsurance because it avoids lengthy court procedures and protects sensitive business information. Options A, B, and D are incorrect. A. Arbitration is an alternative to court, not a requirement to go to court. B. Arbitration does not relieve the cedent of its obligations to pay claims. D. Arbitration can begin without prior mutual agreement on settlements. This process is governed by Massachusetts laws on reinsurance contracts and dispute resolution. Question 6. Scenario-based. Risk transfer and retention. A mutual insurance company decides to purchase an excessive loss reinsurance policy from Harbor Re. The policy specifies that the cedent will retain the first $500,000 of any claim, and the reinsurer will cover amounts exceeding the retention limit. Claim of $1,200,000 is filed. How much will Harbor Re be responsible for paying on terms of the excessive loss agreement? A. $500,000. B. $700,000. C. $1 million. D. $1,200,000. Answer B. $700,000. Explanation: in an excessive loss reinsurance policy, the reinsurer covers losses above the retention limit set by the cedent. In this case, the retention limit is $500,000. The claim amount is $1,200,000, so the reinsurer, Harbor Re, is responsible for covering the portion of the claim that exceeds the retention limit. Reinsurer's responsibility was $200,000. $500,000 annual $700,000. Emma Mutual will cover the first $500,000. Excessive loss reinsurance is regulated under Massachusetts insurance laws to ensure that both parties have clear retention limits to manage large claims effectively. Question 7. Types of reinsurance agreements. Which of the following is the primary distinction between proportional and non-proportional reinsurance? A. Proportional reinsurance involves fixed premiums, while non-proportional reinsurance involves variable premiums. B. In proportional reinsurance, the reinsurer shares both premiums and losses with the cedent, whereas in non-proportional reinsurance, the reinsurer only covers losses above a specified threshold. C. Proportional reinsurance applies only to catastrophic events, while non-proportional reinsurance covers all claims. D. Non-proportional reinsurance, the cedent retains a fixed percentage of every claim, while in proportional reinsurance, the cedent retains a variable percentage. Answer B. In proportional reinsurance, the reinsurer shares both premiums and losses with the cedent, whereas in non-proportional reinsurance, the reinsurer only covers losses above a specified threshold. Explanation: the primary distinction between proportional and non-proportional reinsurance lies in how the risk is shared. In proportional reinsurance, the reinsurer shares a fixed percentage of both premiums and losses. In non-proportional reinsurance, the reinsurer covers losses above a predetermined retention limit or attachment point. Options A, C, and D are incorrect. A. Premium arrangements can vary in both types of agreements. C. Both types of reinsurance can apply to catastrophic and non-catastrophic events. D. The retention percentage in non-proportional reinsurance is not fixed for every claim. Massachusetts regulations require that reinsurance agreements clearly specify the terms of risk sharing to avoid disputes. Question 8. Structure and features of reinsurance contracts. Which clause in a reinsurance contract specifies the conditions under which the reinsurer may cancel the agreement? A. Retention clause. B. Exclusions clause. C. Reinstatement clause. D. Cancellation and termination clause. Answer D. Cancellation and termination clause. Explanation: the cancellation and termination clause in a reinsurance contract outlines the specific conditions and procedures for ending the agreement. It may include notice periods, reasons for termination, and obligations of both parties upon cancellation. Options A, B, and C are incorrect. A. The retention clause refers to the amount of risk retained by the cedant. B. The exclusions clause lists risks not covered by the reinsurer. C. The reinstatement clause specifies how reinsurance limits can be restored after a claim. Under Massachusetts law, these clauses must be clearly defined in contracts to ensure compliance and transparency. Question 9. Massachusetts-specific reinsurance practices. Which of the following best describes the filing requirement for Massachusetts insurers when entering into a reinsurance agreement with an unauthorized reinsurer? A. The insurer must notify policyholders within 30 days. B. The insurer must submit a detailed report to the NAIC. C. The insurer must secure collateral from the reinsurer to cover the full amount of reinsured liabilities. D. The insurer must obtain approval from the Massachusetts Division of Insurance before signing the agreement. Answer: C. The insurer must secure collateral from the reinsurer to cover the full amount of reinsured liabilities. Explanation: when a Massachusetts insurer enters into a reinsurance agreement with an unauthorized reinsurer, state law requires that the insurer secures collateral from the reinsurer to protect policyholders. This collateral must be sufficient to cover the reinsurer's obligations. Options A, B, and D are incorrect. A. Notification to policyholders is not required. B. Reports are filed with the Massachusetts Division of Insurance, not the NAIC. D. Prior approval from the DOI is not always mandatory, but compliance with collateral requirements is essential. This requirement is part of Massachusetts's regulatory framework to safeguard the insurance market from potential risks associated with unauthorized reinsurers. Question 10. Reinsurance agreement basics. Which of the following types of reinsurance involves the reinsurer covering the entire portfolio of the ceding insurer rather than specific individual risks? A. Facultative reinsurance. B. Treaty reinsurance. C. Proportional reinsurance. D. Non-proportional reinsurance. Answer: B. Treaty reinsurance. Explanation: in treaty reinsurance, the reinsurer agrees to cover an entire portfolio of risks held by the ceding insurer based on pre-agreed terms. Facultative reinsurance, on the other hand, is used to cover specific individual risks. Question 11. Regulatory filing requirements. Massachusetts law requires insurers to file a notice of reinsurance transactions with which regulatory body? A. National Association of Insurance Commissioners, NAIC. B. Federal Insurance Office, FIO. Massachusetts Division of Insurance, DOI. D. Reinsurance Association of America, RAI. Answer: C. Massachusetts Division of Insurance, DOI. Explanation: reinsurance transactions by Massachusetts insurers must be reported to the Massachusetts Division of Insurance for regulatory compliance and monitoring. Question 12. Reinsurance and solvency. What is the primary purpose of reinsurance in relation to the solvency of an insurance company? A. To increase the insurer's profitability. B. To reduce the need for underwriting guidelines. C. To stabilize the insurer's financial position and ensure it can meet claims obligations. D. To avoid regulatory compliance requirements. Answer: C. To stabilize the insurer's financial position and ensure it can meet claims obligations. Explanation: reinsurance helps insurance companies manage risk by spreading losses and stabilizing their financial positions, which enhances solvency and reduces the risk of insolvency. Question 13. Retention limits in Massachusetts. What is the maximum percentage of an insurer's surplus that can be retained for single risk under state regulations? A. 5%. B. 10%, C. 20%, D. 25%. Answer B. 10%. Explanation: Massachusetts regulations generally limit insurers to retaining no more than 10% of their surplus on any single risk to avoid excessive exposure. Question 14. Proportional reinsurance. Which of the following best describes proportional reinsurance? A. The reinsurer covers only catastrophic losses. B. The reinsurer shares both premiums and losses with the cedant. C. The reinsurer only pays claims exceeding a specific threshold. D. The reinsurer does not participate in underwriting decisions. Answer B. The reinsurer shares both premiums and losses with the cedant. Explanation: In proportional reinsurance, the reinsurer receives a proportionate share of premiums and covers a corresponding share of claims. Question 15. Claims management. What is the primary responsibility of the ceding insurer in a reinsurance agreement when a claim is filed? A. To notify the policyholders of the reinsurer's involvement. B. To collect premiums from the reinsurer. C. To handle the claim and seek reimbursement from the reinsurer if applicable. D. To transfer all claims management to the reinsurer. Answer C. To handle the claim and seek reimbursement from the reinsurer if applicable. Explanation: The ceding insurer retains responsibility for claims management and can seek reimbursement from the reinsurer for covered claims. Question 16. Non-proportional reinsurance. Which of the following is a key feature of an excessive loss XL reinsurance agreement? A. The reinsurer shares all claims proportionally with the ceding insurer. B. The reinsurer only pays for losses that exceed a pre-agreed limit. C. The reinsurer covers losses from the first dollar of claims. D. The reinsurer assumes underwriting responsibility from the ceding insurer. Answer B. The reinsurer only pays for losses that exceed a pre-agreed limit. Explanation: Excessive loss XL insurance is a non-proportional agreement where the reinsurer pays only for claims that exceed a specified threshold. The ceding insurer retains responsibility for losses up to that threshold. Question 17. Scenario-based. Claims dispute. Linda is an underwriter for a Massachusetts insurance company that has entered into a quota-share reinsurance treaty with a reinsurer. A significant loss occurs and the reinsurer disputes a portion of the claim, citing an exclusion clause in the treaty. Linda reviews the exclusion clause and finds that it was added as an amendment after the initial agreement was signed, but her company never consented. The change. What action should Linda's company take to resolve the dispute? A. Accept the reinsurer's decision to deny the claim based on the exclusion clause. B. File complaint with the National Association of Insurance Commissioners (NAIC). C. Initiate arbitration as outlined in the treaty's dispute resolution clause. D. Terminate the reinsurance agreement immediately. Answer C. Initiate arbitration as outlined in the treaty's dispute resolution clause. Explanation: Most reinsurance treaties include an arbitration clause to resolve disputes. Since the exclusion clause was not consented to by the ceding insurer, the dispute should be settled through arbitration, rather than immediately terminating the agreement or filing complaint with regulatory body. Question 18. Claims settlement in a surplus share reinsurance arrangement. What happens when the ceding insurer's retention limit is reached? A. The ceding insurer retains 100% of any additional risk. B. The reinsurer covers the remaining risk beyond the retention limit. C. The reinsurer and ceding insurer split the remaining risk equally. D. The policyholder is required to cover the excess risk. Answer B. The reinsurer covers the remaining risk beyond the retention limit. Explanation: In surplus share reinsurance, the ceding insurer retains risk up to a predetermined retention limit, and any risk exceeding that limit is covered by the reinsurer. Question 19. Regulatory compliance under Massachusetts regulations. Which of the following must be included in a reinsurance agreement to be considered valid? A. A clause allowing the reinsurer to cancel the agreement at any time without notice. B. An insolvency clause ensuring the reinsurer continues to pay claims if the ceding insurer becomes insolvent. C. A provision transferring all claims handling to the reinsurer. D. A confidentiality clause prohibiting disclosure of reinsurance terms to regulators. Answer B. An insolvency clause ensuring the reinsurer continues to pay claims if the ceding insurer becomes insolvent. Explanation: Massachusetts law requires that reinsurance agreements include an insolvency clause, which ensures that the reinsurer remains liable for claims even if the ceding insurer becomes insolvent. Question 20. Risk transfer analysis. Which of the following is used to assess whether a reinsurance agreement effectively transfers risk from the ceding insurer to the reinsurer? A. Retention ratio test. B. Risk-based capital (RBC) assessment. C. Transfer of risk test. D. Solvency margin calculation. Answer: C. Transfer of risk test. Explanation: The transfer of risk test is used to evaluate whether the financial risk is genuinely transferred from the ceding insurer to the reinsurer under the terms of the reinsurance agreement. Question 21. Catastrophic reinsurance. Which of the following statements about catastrophic reinsurance is true? A. It covers only small, frequent losses. B. It is typically structured as a proportional treaty. C. It provides coverage for large, infrequent losses such as natural disasters. D. It is required by Massachusetts law for all insurers. Answer: C. It provides coverage for large, infrequent losses such as natural disasters. Explanation: Catastrophic reinsurance is designed to protect insurers against large, infrequent losses, such as those caused by hurricanes, earthquakes, or other natural disasters. Question 22. Retention and limit clauses. What is the purpose of a retention clause in a reinsurance agreement? A. To define the maximum premium payable by the ceding insurer. B. To specify the reinsurer's share of profits. C. To set the amount of risk that the ceding insurer retains before the reinsurer pays claims. D. To ensure that all claims are handled by the reinsurer. Answer: C. To set the amount of risk that the ceding insurer retains before the reinsurer pays claims. Explanation: The retention clause specifies the amount of risk that the ceding insurer retains, ensuring that the reinsurer covers only losses above that threshold. Question 23. Claims handling in reinsurance. Which of the following best describes the role of the reinsurer in the claims handling process? A. The reinsurer must take over claims handling from the ceding insurer in all cases. B. The reinsurer reimburses the ceding insurer for claims paid within the limits of the reinsurance agreement. C. The reinsurer is responsible for settling claims directly with policyholders. D. The reinsurer is only involved in claims handling if the ceding insurer becomes insolvent. Answer: B. The reinsurer reimburses the ceding insurer for claims paid within the limits of the reinsurance agreement. Explanation: The reinsurer's role in claims handling is typically to reimburse the ceding insurer for claims that fall within the scope of the reinsurance agreement. The ceding insurer usually handles claims directly with policyholders, while the reinsurer provides financial support. Question 24. Scenario-based. Treaty reinsurance agreement. John, an underwriter, a Massachusetts insurance company, negotiates a treaty reinsurance agreement that includes a stop-loss provision. During the policy year, the company experiences an unexpected spike in claims exceeding normal loss levels. The reinsurer refuses to pay beyond a certain limit, claiming that it only covers catastrophic events. What should John clarify the reinsurer's obligations? A. Refer to the quoted share clause in the treaty agreement. B. Review the retention, limit, and stop-loss trigger in the treaty. C. Initiate legal action against the reinsurer for breach of contract. D. Terminate the treaty and seek alternative reinsurance. Answer: B. Review the retention, limit, and stop-loss trigger in the treaty. Explanation: In stop-loss reinsurance, the reinsurer covers losses beyond a specified limit. John must review the retention, limit, and stop-loss trigger to ensure that the reinsurer is meeting its contractual obligations. Question 25. Ethical considerations in reinsurance. Which of the following is considered an unethical practice in reinsurance operations? A. Full disclosure of all material facts in the reinsurance contract. B. Use of arbitration to resolve disputes. C. Retroactive amendment of reinsurance terms without consent. D. Pooling risks among multiple insurers to reduce exposure. Answer: C. Retroactive amendment of reinsurance terms without consent. Explanation: Amending reinsurance terms retroactively without the consent of both parties is unethical and may be considered a breach of contract. Ethical practices require transparency and mutual agreement in all reinsurance dealings. Question 26. Massachusetts reinsurance regulations. Under Massachusetts law, which entity oversees the licensing of reinsurers operating in the state? A. The National Association of Insurance Commissioners, NAIC. B. Financial Industry Regulatory Authority, FINRA. C. Division of Insurance, DOI. D. Federal Insurance Office, FIO. Answer: C. Division of Insurance, DOI. Explanation: the Massachusetts Division of Insurance, DOI, is responsible for licensing reinsurers and ensuring compliance with state regulations governing reinsurance operations. Question 27. Risk retention strategies. Which of the following is a key factor in determining an insurer's risk retention strategy in reinsurance? A. The policyholder's premium payment history. B. The insurer's financial capacity and solvency margin. C. The reinsurer's market share. D. The type of claims filed by the policyholders. Answer: B. The insurer's financial capacity and solvency margin. Explanation: an insurer's risk retention strategy is based on its financial capacity and solvency margin to ensure that it can handle claims without over-relying on reinsurance. Question 28. Catastrophe modeling. What is the primary purpose of catastrophe modeling in reinsurance? A. To calculate policyholder premiums. B. To forecast annual profit margins for reinsurers. C. To assess potential losses from natural disasters and extreme events. D. To determine underwriting guidelines for standard policies. Answer: C. To assess potential losses from natural disasters and extreme events. Explanation: catastrophe modeling uses data and simulations to predict potential losses from natural disasters and extreme events. This is crucial for reinsurers to structure appropriate coverage and pricing for catastrophic risks. Question 29. Proportional versus non-proportional reinsurance. Which of the following statements correctly differentiates proportional and non-proportional reinsurance? A. In proportional reinsurance, the reinsurer only pays for losses exceeding a certain threshold. B. Non-proportional reinsurance involves sharing premiums and claims on a fixed percentage basis. C. Proportional reinsurance requires the ceding insurer to retain all claims below the retention limit. D. In non-proportional reinsurance, the reinsurer pays only for large losses that exceed an agreed limit. Answer: D. In non-proportional reinsurance, the reinsurer pays only for large losses that exceed an agreed limit. Explanation: in non-proportional reinsurance, the reinsurer pays for losses that exceed a specified limit. In proportional reinsurance, premiums and claims are shared based on a fixed percentage between the ceding insurer and the reinsurer. Question 30. Reinsurance accounting principles. Which of the following is a key accounting principle applied to reinsurance transactions? A. Claims are recorded only after full payment is made to the policyholder. B. Premiums ceded to the reinsurer are treated as an expense by the ceding insurer. C. The reinsurer records claims liabilities on behalf of the ceding insurer. D. Reinsurance transactions are excluded from the ceding insurer's financial statements. Answer: B. Premiums ceded to the reinsurer are treated as an expense by the ceding insurer. Explanation: in reinsurance accounting, the ceding insurer treats premiums paid to the reinsurer as an expense. This reduces the insurer's net premium income on its financial statements.